Hello my friends and welcome back to another exciting lecture on IAS2 Inventories. In today's lecture, we are diving deep into net realizable value, that is NRV, and exploring how to account for inventories. Now, I know inventories might sound like a simple topic, but when we start discussing write-downs, losses, and reversals, that's where things get interesting and sometimes tricky. So pay attention because there is a lot to learn today. First thing first, what exactly is net realizable value? NRV is the price at which you expect to sell an item for in the ordinary course of business, less estimated cost of completion and estimated cost necessary to make the sale, things like packaging or delivery charges. As we discussed earlier, the basic rule for measuring inventories is to keep the inventories at lower of cost and NRV. Let me repeat that because it's very important. Lower of cost and NRV. You need to make sure that inventories in your financial statement are not stated above its net realizable value. Why? Because we don't want to overstate our profits by keeping inventories at a higher value than we can actually recover for them. If net realizable value is lower than cost, then you need to write down your inventories to their net realizable value. Now, the big question is, when can NRV fall below the cost? Let's explore that. Imagine you are in the concession business and suddenly the cost of raw material like cement and steel skyrockets. In such case, the cost to complete your existing project would increase. Or maybe a competitor launch a similar product at a lower price, forcing you to cut down your selling price to stay competitive. This could happen in industries like fashion, electronics, or even cars. Another situation can be, what if your inventories get damaged, expired, or spoiled? For example, in the food industry, products can spoil very quickly. A dented can or a slightly damaged box could force you to sell at a discount. Then your inventories might become obsolete. We all have experienced this one because of technological updates. Think of mobile phones or laptops. Whenever a new model is launched, the older model suddenly lose value. Well, there is nothing wrong with the physical condition, but newer models can push down the selling price of the older models. Also, sometimes businesses might deliberately sell product at a loss as a part of a marketing campaign, like clearance sale, discounts or bundled offer to attract more customers. Or even mistakes can happen. Wrong specification, quality defects, or incorrect purchases could lead to price reductions. These errors might result in pressures to decrease the selling prices. Alright, now that we know why NRV can drop, let's talk about how to assess NRV. NRV is assessed either item by item or by grouping similar items. Item by item means you check each product individually to see if its recoverable value has dropped. And by grouping similar items means you can group similar or related products like shoes of different colors or sizes and assess their NRV together. But, and this is important, you cannot recognize a general write down. For example, you cannot just decide that 10% of all the finished goods will be written down without doing an item by item or group by group analysis. You should evaluate the net realizable value at the same time as you estimate the sales price. It is important to assess the NRV at the end of each reporting period and compare it to the cost of inventory. Also, make sure to consider any price or cost fluctuations that are linked to events occurring after the reporting period. Then, think about why you are holding the inventory. If the inventory is held specifically to fulfill a contract with customer, then NRV should be based on the contract price. However, if the inventory is held in general for making sales, then you should ignore any contract price and instead use the general selling price in the market. Now, here is something to note. There may be situations where NRV initially falls due to factors like declining prices, but later prices go back up again. When that happens and the NRV increases, you can reverse the write down you had previously recorded, but only up to the original cost of the inventory. Alright, my friends, now it's time to put it all together and discuss how to account for inventories, specifically when and how to recognize expense against the inventory in the profit and loss statement. First of all, when you sell inventories, you need to remove their carrying amount from your books and record it as an expense in the profit and loss statement. General entry for inventory sold would be cost of sales would be debited, recognized as expense in the profit and loss, and inventories would be credited to remove it from the assets. Let's say you sold goods that cost $50,000. The entry would be cost of sales would be debited by $50,000 and inventories would be credited by $50,000. This expense is recorded at the carrying amount of inventory, whether it is based on cost or NRV, depending on whichever is lower. Remember, we have already discussed cost formulas like FIFO and weighted average method in earlier lectures to determine the cost of inventory. Now, what happens if the NRV of your inventory drops below cost? Well, my friends, when that unfortunate situation occurs, you need to write down the inventories and recognize the loss immediately. General entry for write down. Write down of inventories would be debited, recorded as expense in the profit and loss statement, usually within cost of sales, and inventories would be credited or an allowance account if you are tracking it separately. Imagine you have inventory worth $20,000, but due to price drops or damage, its NRV fall to $15,000. The write down entry would be write down of inventory or cost of sales would be debited by $5,000 and inventories would be credited by $5,000. Now, here is something to think about. Should you present this write-off as a separate expense or combine it with the cost of sales? The standard IAS 2 does not require separate presentation, but it does ask you to disclose it clearly in the notes to the financial statement. And finally, what if price bounce back later and the NRV of the inventory increases? Can you reverse the earlier write down? And the answer is yes, but only to the extent of previous write down. In other words, You cannot reverse more than what you originally wrote down. And journal entry for reversal of write down would be inventories would be debited to restore their value in the books, and cost of sales would be credited or a separate reversal account in the profit and loss statement. Let's say the earlier write down was $5,000, but now the NRV improves and you can reverse $3,000 of it. The journal entry would be inventories would be debited by $3,000 and cost of sales would be credited by $3,000. IAS2 also requires clear disclosures about inventories in the notes to the financial statement, including number 1, the accounting policy used for inventories. Number 2, the total carrying amount of inventories and its classification, like raw material, finished goods, or work in progress. Number 3, write downs and reversals recorded during the period. And number 4, if any inventories are pledged as security for some loans. Alright, my friends, that's wrap up our today's lecture on NRV and accounting for inventories under IAS2. We covered why NRV can drop, how to assess NRV, accounting entries or journal entries for sales, write-downs and reversals, and the key disclosures that are required by IAS2. I hope you enjoyed today's session. If you are still feeling unsure, rewatch this lecture and go through the examples again. Until next time, and thank you and see you in the next lecture.